one of the greatest compounding machines in the market today, intentionally loses money on its most important product. But once a customer buys in, they're basically locked in for the next 25 to 30 years. That company is GE Aerospace. And if super investor Chris Hohn owns $14 billion worth of this company, you should probably own some too. So today I'm going to show you exactly what's going on inside this company, whether the stock is actually worth what the market is paying for it, and the risks that could derail this entire thing. But before we dive in, if you like these longer stock analysis videos, consider subscribing. I'm definitely planning on making more of these. We're going to cover 4 main areas today: what GE Aerospace actually is and how it got here, the business model and how they make money. Later on, we'll look at some bull cases and some bear cases so we can see every side of this. And then towards the end, I'll look at their valuation and I'll run a DCF model and we can try to figure out what this thing is actually worth. So for a quick backstory, GE is an incredibly old company. Thomas Edison was actually one of the founders back in 1892, so I'm sure that you've heard of them. They've done pretty much everything under the sun, from making light bulbs to dishwashers to, in this case, jet engines. But as it turns out, doing everything doesn't really provide the most stable cash flow. And I think the CEO, Larry Culp, knows this because as of April 2024, he split the company into 3 segments: GE Healthcare, that focuses on healthcare technology; GE Vernova, that focuses on energy; and GE Aerospace, this incredibly wide moat compounding machine that creates jet engines. GE Aerospace kept the ticker and all of the previous financial data, which we'll look at later on. This restructuring is important because there's this phenomenon in the markets called conglomerate discounts, where basically whenever you have a company as large and as complex as GE, it's hard for investors to put a price on it and to price all of the moving parts. But now that they've trimmed off some of that fat and they're honing in, they're not only able to become more efficient from a company and leadership standpoint, but they're also able to become more efficient at raising money in the stock market. But now that we understand the recent shift that has happened within this company, let's talk about their business model. They make these big, complex, expensive engines, knowing they're probably not going to make money on them when they sell it. So they don't. They sell their engines at razor-thin margins, sometimes even for a loss, but they do it so they can grow their install base. And because of this, they have a fleet of 80,000 engines and 2.3 billion flight hours as per their investor presentation. Once a GE engine is flying, the airline has almost no choice but to use the GE approved parts and service networks for the life of that aircraft, which is typically around 25 to 30 years. This is just like Apple's aftermarket monopoly on their repairs. And because of the Federal Aviation Administration, only GE certified parts can be used in their overhauls and a majority of their repairs. But there's 2 sides to this. Not only are they receiving maintenance revenue for the life of the aircraft, but they also sign long-term service agreements and flight hour contracts where they literally charge airlines per flight hour. This leads to very high margin, very predictable cash flows that they then use to fund more engine creation, which again they sell at cost, which again grows their install base, which again locks them in for another 25 to 30 years of consistent revenue. It's just a constant loop. So I've already talked partially about their moat, but I want to touch a little bit more on that, and I also want to talk about the market that they're in. GE Aerospace shares an oligopoly with really only 2 competitors, Rolls-Royce and Pratt & Whitney. And honestly, for a good chunk of their business, their competition is even smaller. Rolls-Royce doesn't make any engines for narrow-bodied aircraft. So for a plane like the Airbus A320, that pretty much leaves Pratt & Whitney as their only competition. And I will give it to them, their engine for that plane is more efficient than GE's engine. But as luck would have it, they started having these problems. They started wearing out faster than they should have. And Pratt & Whitney had to do this huge major recall on these engines. And they lost a shit ton of money. Companies went bankrupt. It was very bad for Pratt & Whitney, but that allowed GE to pretty much inhale their market share on this plane. I guess I should explain that GE doesn't get 100% of this. It technically goes to CFM International, which is a joint venture between GE Aerospace and Safran, this French company. They split everything 50-50, but GE is the design lead on the core engine technology, whereas Safran handles the fan and the low pressure system. So GE really maintains control over the most important pieces of it. All that to say, they're not really competitors here. They both benefit from this. But going back to what I was talking about earlier, CFM creates these LEAP engines, which now account for the vast majority of the Airbus A320 family. Not only that, but the Boeing 737 MAX exclusively uses the LEAP engine from these companies. According to Google, Airbus and Boeing combined make up about 89% of the narrow-body market share, and GE having a major hold on this is a very good sign. This is why Chris Hohn has made GE the backbone of his portfolio. GE virtually has zero competitors, and that's Chris Hohn's whole philosophy: the less competitors, the better. And it makes sense. If you don't have any competitors, your pricing power is infinite. Look at FICO up until literally like just now. And it's not because no one wants to compete, although I'm sure they don't, because that would be a death sentence. It's because they can't compete. For starters, a lot of people just don't have enough money. Rolls-Royce, this giant, one of their two competitors, almost went bankrupt trying to build an engine in the 70s, and they had to get bailed out by the government. A single LEAP engine on the low end costs $14.5 million. I don't mean to shame my viewers, but I doubt anyone watching this video has that kind of money. And if you did, and you wanted to make an engine, well, now you got to figure out how to build the thing. That's hurdle number 2. These engines are so complex, there hasn't been any new entrant in this space in the last 50 years. People have tried. I got this picture from Joseph Carlson that I think is pretty funny, but there has been competitors that have tried and they just can't compete. GE comes out on top every single time. Now that brings us to the third hurdle. Just because you made an engine that turns on doesn't mean you're done. Now you have to make it commercially safe and you have to abide by the FAA guidelines. So not only do they have a large economic moat, but they also have a large regulatory moat backed by the FAA. And because of these FAA guidelines, airlines can't just shop around for cheaper parts and maintenance. And a great point that Joseph Carlson brought up is, let's say you have some GE engineers that go off, they make their own company, and they make an engine that works. An airline isn't going to just buy one engine and say, all right, I saved some money, perfect. First of all, they're not just buying one engine, but also they have to buy a new fleet of engineers and parts on top of the engine so they can help service it and maintain them. This company benefits from high switching costs, which I'm sure a lot of you know are a very common trait amongst many wide moat companies. I forgot to say this earlier, but GE doesn't just stick to narrow-bodied aircraft. That's just their biggest moneymaker, but they have their hands in everything, including a quarter of their revenue coming from military, defense, and propulsion contracts. It's safe to say this company is very well insulated from a lot of different risks, including one of the most prevalent ones recently, AI. I found an article on PitchGrade. It's an AI website, so maybe there's a little bit of a bias, but it was written by Luciano Colos, and he says that GE is arguably the most strategically well-positioned industrial company in the S&P 500 for the AI era. He then talks about 4 primary ways AI actually benefits GE, and he writes a pretty solid article, but I really didn't want to spend too much time on this. I just figured I'd share it because I found it while I was researching this, but I will link it in the description of this video. At this point, you can probably assume GE is a very high-quality company, but you can't truly understand a company until you look at some of their bear cases and risks, so we shall do that now. I've read articles, I've watched videos, I've read some of their 8 and 10K forms, and there's really only 2 risks that stand out to me. The first one's a little bit more speculative, and it's literally just based on some things I've seen on the internet. But with this whole Strait of Hormuz situation going on, I've basically just seen that crude oil now has a new normal, supposedly around $90 a barrel. This is because in the entire history of the Strait of Hormuz, we have never had it closed, and everyone just thought that's how it was. But now that we know it can be closed at any time for any reason, there's basically just a tax on it, more or less. Obviously, if oil and fuel is more expensive, it's going to put a damper on GE, but I really don't even think this is a big problem because 1, it'll kind of get acclimated to it, and 2, if crude ever got to the point where nobody could afford to do anything, it literally wouldn't even matter. Very high level analysis by yours truly, but that's how I feel like a lot of the risks are for this business. The smaller stuff like tariffs really doesn't even matter, and even the major stuff we can get past. Are we going to be flying 50 years from now? Probably. From just traveling for vacation or work, or for transporting material just like trains, air travel is extremely important, and GE is part of the core infrastructure to this business. But okay, I said there were 2 risks. What is the next one? Basically, like with literally any company, it seems like China. China is spending a lot of money trying to build new aircrafts and trying to build engines, and people think that's really going to put a damper on GE's business model. And maybe they will lose money in the short term, but let me tell you, that is not going to destroy GE. First of all, the FAA again. We don't know what the hell China is doing with these engines. We don't know how they're making them. They need to be FAA certified, so they're probably not going to allow that. And two, China is technically somewhat of an adversary. They're also not going to allow that. Really and truly, I think GE is shielded literally from every possible angle, whether it's because their business model is incredibly amazing or because the freaking government is going to bat for them. Now, honestly, this whole video is a bull case, but I'll run through some bull cases and tailwinds real quick. Like I said earlier, the whole Pratt & Whitney recall that allowed GE to grab more market share and further strengthen their grip on this industry. Larry Culp seems to be doing at least a decent job as CEO, and recently he's been focusing on his whole flight deck model where he prioritizes safety and quality before delivery and cost. And that seems to be working out for them. And then there's the fact that essentially the entire world is growing in GDP, and over time, that will lead to more flying. Actually, as of February, the total market's revenue per kilometer was up 6.1%, and Africa's revenue per kilometer specifically was up 11.9%. I don't think I said this, but Joseph Carlson called them a hidden royalty on global GDP. And honestly, I think he described it perfectly. Now it's finally time to start looking at their financials. My screen recording hasn't been working recently, but I'll just throw some pictures on screen. One thing that I want to point out is, again, after their whole restructuring, all of their charts started looking a lot prettier. And as of Q4 2024, their revenue has pretty much been rising ever since. It's up 18.5% year over year, and as of the most recent quarter, their revenue was $45.89 billion. There's this new charting tool on Qualtrim, and I made this picture that I thought looked pretty cool, but as we can see, their earnings per share, their free cash flow per share, and their operating margins have all been rising. It's kind of hard to see, but their operating margins are sitting somewhere around 18.5%. And their free cash flow and their earnings per share specifically have been skyrocketing. It's crazy how fast they're growing. This is going to be a lot of words, but their stock-based compensation adjusted free cash flow per share is up over 100% year over year. Now, if you didn't believe me earlier when I said they were becoming more efficient, let's look at their return on capital employed. It has been rising incredibly consistently, and it seems like they're creating a new standard for themselves. The past 3 quarters have had double-digit numbers. That pretty much wraps up the financial section. Obviously, we don't have too much data to look back on because of the split, but everything seems to be on phenomenal trajectory, and everything's growing at double-digit rates. And with that, we can take a look at their valuation and get a gauge on what our returns would be. So historically, they traded at a 10 to 15 PE. And if we take a look at their chart, we can clearly see it jumped up after they separated. This was the market re-rating the stock, giving it a new price. And I think they priced in everything pretty accurately, as they pretty much always do. But you have a company with a huge annuity-like revenue stream, and they're growing at double-digit rates. I think between 35 and 40 is the perfect PE for it to be. I know some people might consider that a little high, but you got to remember, investors are willing to pay a premium for certainty. And with GE Aerospace, I find it extremely difficult to find anything uncertain about them. All that to say, I think they're reasonably valued right now, but let's run a DCF model to see what our returns could be. So earnings per share growing at a rate of 36% right now. I want to be extremely conservative, so let's cut that down to 12, and then their PE stays from around 39 to 40, but we'll cut that down to 30. This is a bear case. With these numbers, we should see about an 8.8% average return over the next 5 years, so pretty much in line with market averages, at the worst possible scenario. If we bump this up a bit to what I believe is base case, earnings per share growing at 15%, PE ratio about 35, we will see a 15.25% average return over the next 5 years. That is crushing the market, and that is base case. And if we bump these numbers up one more time, earnings per share at 18%, PE ratio at 40, we should expect to see a 21.45% return from today's price. That is phenomenal. I honestly feel like all of these are a bit conservative. I know I said they did a pretty good job of pricing it, and I still believe that, but at the same time, this is very early on in this new stage of GE's life. There could be a lot of things that investors didn't expect or didn't understand, and it causes them to skyrocket even more. And now that they're a pure aerospace play, I think it'll allow investors to look at them a lot more closely. And I think as time goes on, more and more investors are going to get on this GE train, and I think more and more investors are going to start to realize the type of company they are and how dominant they are at what they do. Let me know what I missed. Let me know what I got completely wrong. I would love to hear your feedback in the comments. But I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.